welcome to this session on international taxation. So over the last 8-9 months, there have been a lot of developments which have happened in the area of international taxation in UAE. And particularly, this thing has been revolving more around the examples, the clarifications, the details that have come in the business guide relating to the taxation of non-resident. And another area that we are not covering today, but is equally important from an international tax perspective, is the transfer pricing guide that has come in. So for the purpose of our presentation today, because it's a presentation that we are covering in the next 45 minutes, we will be looking at certain key developments that will be covered as a part of the international taxation. When we talk about international taxation, generally, the way it works is that you have domestic tax law, just like you have a UAE corporate tax law. And then there are tax treaties, which might be the domestic country and another foreign country. So in this corporate tax law, that serves as a domestic tax law. And then if a foreign company or a non-resident individual or a natural person is doing business in the UAE, there might be a tax treaty which UAE may have with the country of residence of that taxpayer. So let's say, for example, if the non-resident is from KSA, there might be a tax treaty between KSA and UAE. And if that tax treaty provides any additional advantages or any additional benefits, whereby the non-resident can claim exemption in respect of a particular income, which otherwise may be taxable under the UAE corporate tax law, that is something that you can go for. And this is something which is covered in Article 66 in the UAE corporate tax law itself, which says that whenever there's an international agreement, the terms of that provisions of the domestic UAE corporate tax law. Maybe, just to see as to how this works. So let's say you have a particular person who's taxable under the UAE corporate tax law. If he's also taxable under the tax treaty, then this income is going to be taxed. But if there is a situation, income is taxed under the UAE corporate tax law, but it is not taxable under the tax treaty, then in that case, there will be no tax on the income of the non-resident, even though the domestic tax law provides for taxation. The third situation, which also comes across, although it's seldom, is an income itself is taxable under domestic tax law, let's say the UAE corporate tax law, but it is taxable under the treaty. In those cases, a non-resident has a choice. They don't need to go and opt for the treaty provision. They can claim an exemption within the domestic tax law provisions. Now, when we talk about a non-resident, the next question is, what form of income of the non-resident is liable to UAE corporate tax? For this purpose, broadly, the non-residents are classified into two categories. One, who are natural person, and the other who's a juridical person, something like a company. When we talk about a company, we're talking about a foreign company which is not controlled or managed from UAE. Because if that be the case, then by default, such a company becomes a tax resident of UAE. And therefore, this particular aspect need not be looked into. For a resident, their all income will be taxable in the UAE. And this is something which we have come across quite often, particularly for companies which are owned by individuals, 2 or 3 individuals, who are their directors sitting in the UAE and running operations, which could be in Europe, which could be in other Middle East region, etc. And they are the ones who are running the company, but basically they are based out of UAE, taking all the calls relating to the control and management. So for those companies by default become UAE tax resident. And those are not the ones that we are discussing in this particular slide. Now, when we talk about a natural person, the income of the natural person which is liable to taxes if they are conducting a business activity which results in a permanent establishment in the UAE. A PE, honestly speaking, is a concept that can take maybe, I don't know how many number of hours to discuss. So today we are just going to look at the broad concept of PE under the UAE corporate tax. But if a natural person has a permanent establishment in the UAE, or they derive something what is known as a state-sourced income, a UAE-sourced income, then in that case, these two incomes could be taxable in the hands of the natural person. Now, of course, there are conditions as to when they are required to register, will they be able to claim an exemption, and other things like that. But these are the two cases where a natural person who's a non-resident may be liable to UAE corporate tax. When we come to a juridical person, the first two remain the same. That is, if such a, let's say, a foreign company has a PE in the UAE, or they derive UAE sourced income, they will be liable to tax in the UAE. One additional aspect that is there in the case of a company is that if they have a nexus in the UAE, and this nexus has been more particularly referred to as if they have any immovable property in the UAE and they earn income from such immovable property, that income will also be liable to tax in the hands of the non-resident. So think of a case where a non-resident has, let's say, some land in UAE, and this land they allow for a rental to various parties to organize events or some of these things, or they have an immovable property that they've leased out. All those income from such kind of land or immovable property will be taxable in the hands of the juridical person. Now, when we talk about the registration, the requirement to register for UAE corporate tax, in case of a non-resident, let's say if it's a company, if they are subject to tax because of the reason that they have a permanent establishment in the UAE or they have a nexus in the UAE, they are required to obtain corporate tax registrations. However, if a non-resident is deriving UAE sourced income, but they neither have a PE nor have any form of nexus in the UAE, they are not required to obtain a corporate tax registration. This is something that has been explicitly mentioned in the Guide for Non-Resident Taxpayers issued by the FTA. When we come to a non-resident natural person, in their case, if their revenue actually exceeds 1 million dirhams, that is when the requirement to register for corporate tax arises. If the revenue does not exceed 1 million dirham, then basically it has been given that they are not required to register for UAE corporate tax. Now, let's look at this particular slide where we've just tried to cover three separate aspects which might be relevant from understanding the taxation of a non-resident. The first one is that, let's say there's a foreign company which is engaged into marketing activities. Now, this company, if it provides marketing services to a free zone branch of another company in the UAE, whereby they are just doing certain marketing work sitting outside UAE. And again, all these are something which is so international taxation to a large extent is also dependent on facts. Even though two people might be providing the same services, a slight change in the fact can actually trigger a different set of taxation. So let's say, for example, if you have a foreign company which is providing marketing services, they don't have an office, they don't have anything else in the UAE. All the work is being done outside UAE, but they get income from a person who is a tax resident of UAE, then this is something which is referred to as one of the state sourced income or UAE sourced income. But if they do not have any form of a presence in UAE, so right now we're just looking at this set of facts for the purpose of our discussion. But if they don't have any form of presence in the UAE, then the income that they get from this activity will not be liable to UAE corporate tax. And therefore, they will not be under an obligation, assuming this is the only line of income that they are getting. But when we talk about, let's say, they also have a permanent establishment in the UAE. And let's say they earn income from this permanent establishment, which is by way of a service fees. Now, even though from a marketing services standpoint, they were not required to register, if they have a permanent establishment in the UAE, then they will be required to obtain UAE corporate tax registration. The third situation could be that in addition to this and this, they also had an immovable property and they were deriving rental income from such immovable property. Again, this will also form a kind of a nexus for them in the UAE, and this income will also be liable to UAE corporate tax. So when this foreign company actually files a tax return, if it is getting all the three income, right? One needs to offer the income from immovable property and PE to taxation. The taxability of these marketing services would be governed on whether these marketing services are unrelated to the PE or these are attributable to the PE. So if they are not related, then currently one can take a stand that these are not taxable. But if these are attributable to the PE, even these income need to be paid, included in the taxable income and paid. Of course, once we progress with the UAE corporate tax and we see as to how the forms, etc., are coming in, the chances are that these kind of income may also require disclosure, even if they are not taxable. So, like I mentioned, in respect of a non-resident natural person, the requirement to register for corporate tax is triggered only when their revenue exceeds 1 million dirhams during a Gregorian calendar year, which is basically between 1st of January to 31st of December. Now, on the practical side, there may be certain challenges whereby, one may actually have a different financial year instead of the calendar year. And the question that comes up is, for looking at this exemption, are we required to again recalculate the revenues for the calendar year? From what has been clarified and what it appears, that the calendar year revenue needs to be calculated irrespective of the accounting year followed by the natural person. But when you are looking at calculating the limit of 1 million, any form of wages, sorry, just give me a minute. Any form of wages, salary, which are derived under an employment contract by the non-resident needs to be excluded. Any returns on personal investment, which do not require obtaining a license, needs to be excluded. And any income from real estate investment, which are not conducted through a license from an authority, also needs to be excluded to calculate the 1 million dirham criteria. So the next question is, what would be the corporate tax rate on a non-resident? And these are more or less in line with what is there for the residents as well. So for a non-resident, which is subjected to UAE corporate tax and which is not a free zone company, they have to pay 0% on AED 375,000 and 9% on income which is exceeding 375,000. Now, the income that a non-resident earns may be earned in the UAE or outside UAE. It doesn't matter. So long as this income is attributable to the UAE operations. So when we talk about a non-resident, they may have certain businesses outside UAE. The income from all these businesses need not be considered for UAE taxation unless and until this income is also attributable to the permanent establishment of the non-resident in the UAE. For example, if you practically see, let's say this PE is engaged into providing services, and it's got 10 employees, out of whom 5 employees are working for UAE clients and 5 employees are working for, let's say, KSA clients. Then in that case, because that income is attributable to the PE, the employee in the UAE are the ones who are doing this activity. The entire income earned from those 10 employees, irrespective of whether the income is from within the UAE or outside the UAE, will be included. But if they are earning any income which is unrelated to this PE, then that is something which will not be considered for taxation here. But if the non-resident is a qualifying free zone person, so let's say if they've got a branch in the UAE, then the tax will be 0% on qualifying income and 9% on income which is not qualifying income. Again, the income might be within or outside the UAE as long as it is attributable to the operations in the UAE. Let's look briefly upon what exactly is UAE sourced income. So UAE sourced income, is an income which is derived from a resident person. That is, if you provide services to a UAE resident, if you as in a non-resident, and they generate income from such activity, that is something which is considered as a UAE sourced income. Currently, because the withholding tax in UAE is 0%, therefore, even if you derive income from UAE, there will be no withholding taxes which will be implied unless and until this UAE sourced income is attributable to a permanent establishment in the UAE. In that case also, the withholding tax might be 0%, but that needs to be offered to tax in the UAE. Payment attributable to a UAE PE of a foreign company. We'll just see an example to cover this particular part. And then there could be income which is accrued in as in, let's say, certain employees of the foreign company are sitting in the UAE and conducting those activities. So income would accrue in UAE, derived from activities or contracts performed in the UAE, assets located in the UAE. So let's say, for example, if there is a machine that is given out, an automated machine that is situated in something which could be a UAE sourced income, it can also get covered as capital invested. So if you give a loan to a person in UAE and they pay interest to you, even that interest income can be a UAE sourced income. Rights used or services performed or benefited from in the UAE. I think we'll just come back to the questions in a short while. So let's look at an example in this particular case. So here what is happening is that we're looking at income derived from a UAE resident. So if there's a UAE LLC, it obtains certain professional services from a foreign company for which it makes a payment of AED 600,000. In this case, because the payment is derived from a UAE resident person, this will be considered as a UAE sourced income. Now, there's a difference between being a UAE sourced income and an income which is liable to tax in UAE. So what we are looking at on the last slide and right now is whether it constitutes a UAE sourced income or not. If it does not cause a UAE sourced income, there's no taxation. But if it is a UAE sourced income, then you need to see whether further conditions are met, and therefore, is it liable to UAE corporate tax or not? The second could be a situation where an income is attributable to UAE of a foreign company. If you look at this particular slide, what is happening here is that there's a foreign company which has a permanent establishment in the UAE, right? This PE is actually, so FCO2 is a foreign company that has a PE in the UAE. This PE availed services from another foreign company in connection with provision of services to a UAE company. So let's say this PE was providing services to a UAE client. And in providing these services, they obtain certain services here. Now, when we talk about this kind of a payment, this payment can actually be done either by the PE themselves, or in some cases, what happens is that the head office makes the payment directly, right? So even if this payment is made directly, because this is attributable to the operations of the UAE company, even though the payment is from one foreign company to the other, it is treated as an income which is state-sourced income from a UAE corporate tax perspective. The next one is interest paid to a non-resident. So in this example, there's a foreign company that has granted a loan to a UAE LLC. This LLC has provided an immovable property situated in the UAE as a security, and it pays interest income to the foreign company, right? So where the borrower of the loan is either a resident person or a government entity, it doesn't matter whether the loan is secured or unsecured, the interest income on such loan will be considered as a state-sourced income. Now, when we talk about the state-sourced income, some of the issues that one needs to keep in mind is that currently the withholding tax on such payment is 0%. There may be a possibility that at some point in time, there could be a withholding tax that could be imposed on this, because generally what happens is globally, when you have these kind of income, which are considered as UAE sourced income under the corporate tax law, there's a withholding tax that is applied on them generally on a gross basis. So let's say there could be a 10% withholding tax on such payment, 15% tax that could be on such payment. It could even be a 0% under the relevant tax treaties. You just need to see what is the provision of that particular tax treaty that is there. Now, in withholding tax, even though this point is not relevant right now, you also again need to go back and understand that, like I mentioned in the beginning of this presentation, the rate which is applied is the better of the corporate tax provision or the tax treaty. So today, a tax treaty may provide that the withholding tax has to be 15% in UAE. But because under the domestic tax law, this is zero, the better from a recipient perspective is 0%, he's opting for this. But tomorrow, let's say if this rate was to be 9%, and in some of the treaty, this rate was to be 5% only, then you could actually opt for a 5% withholding tax because the provisions of the tax treaty are more beneficial. The second is, if you have a UAE sourced income, you can also have a permanent establishment. So there is no, I would say there is no mutual exclusivity that is there from the existence of a permanent establishment and earning UAE sourced income. You can have either or both of them. But the question is that if this income is attributable to the PE, then all the provision of taxation apply accordingly. But if it is not attributable to the PE, then the taxation is not triggered based on the current provisions which are there. Nexus, again, the same thing which we saw in our example, that you may earn state source income, but if you also have, let's say, an immovable property situated in the UAE, then the nexus rule will be triggered. Now we'll just briefly look at the concept of permanent establishment. So just like any other, I would say, tax treaties that are there, the UAE corporate tax law provision also has in Article 14 various subclauses that kind of are modeled around a typical tax treaty that is there. While it will be difficult for us to go through them in detail, I would briefly just touch upon in terms of what each of these clauses mean and how they need to be looked at from an international tax standpoint. So first is that there could be various, so Article 14 paragraph 1 prescribes that, and okay, maybe before I move ahead with this, again at the cost of repetition, Article 14 is nothing but the domestic tax law of UAE. If there is a tax treaty between UAE and the country of residence of the non-resident, you again need to go back and see what are the provisions relating to the existence of a permanent establishment in tax treaty. And if they are more beneficial, they are the ones which are going to apply. So Article 14.1 basically outlines that what will be the instance when a PE will be created. And this is generally referred to as a fixed place permanent establishment. This kind of permanent establishment arises when a non-resident has some fixed place in the UAE. This could be in the form of an office, it could be in the form of a branch, it could be a workshop, factory, or it could be even certain equipments which are installed at a fixed place. The second basically provides that what all are specifically included in the fixed place of business. So para 1 basically gives the general definition, and para 2 says that specifically an office, a branch, a factory, etc., will be included in para 1 for the purpose of being a PE. The third paragraph is basically on specific exclusions. Now, when a taxation is introduced by any country, there is a cost of collection of taxes as well. That could be in the form of maintaining adequate manpower to deal with those cases, the cost of litigation, etc., even from the revenue side. So Article 14, paragraph 3 basically lists down that certain activities which are basic or preparatory right? We do not represent the core income or core business of the non-resident. If a non-resident is doing those activities in the UAE, those will not result into a permanent establishment. However, paragraph 4 basically lists down that Article 14, paragraph 3 provisions will not apply if, let's say, you do activity A, B, and C, which are preparatory, but together they form the core business of the non-resident. In those cases, this exclusionary provision will not apply. Paragraph 5, 6, and 7, basically 5 and 6 deal with something which is referred to as an agency fee. So in many cases, what can happen is that the non-resident may not want to do the business themselves. So what they do is they find out someone locally who's able to do the business that or the activities that a non-resident has to do. And they act as an agent of the non-resident. Now, when we talk about agent, this in international tax parlance consists of two sets of agent. One is referred to as a dependent agent, and the other one is referred to as an independent agent. In simple layman terms, what it implies is that if the person acting in UAE is dependent on the non-resident, maybe because they are working exclusively for the non-resident, maybe because their economic dependence is on the non-resident, maybe because they are legally dependent on the non-resident, and what they are doing is that they are negotiating and concluding contract for the non-resident in the UAE, or they are doing everything that the non-resident would have done except for the signing of the contract, they will be considered as something which is referred to as a dependent agent. A dependent agent generally constitutes a permanent establishment for the non-resident, and therefore the non-resident has to pay taxes in the UAE. Whereas an independent agent is the one who might be working for the non-resident on a non-exclusive basis, may not have any form of a legal or economic dependence on the non-resident. Para 7 is a general clause which specifies that there could be certain conditions which might be specified by the minister. So I think we've discussed this. This is again something, from a PE perspective, you have the corporate tax law and you have the tax treaties. In case of a conflict between these two, the provision of tax treaties will apply. But in case there is no tax treaty between the country of residence of the non-resident and UAE, in that particular case, the UAE domestic tax law provisions will apply. Let's look at a few things about fixed place PE business, because this is something which is important. Generally, a fixed place PE will arise when the non-resident conducts operation in the UAE for more than 6 months. So let's say if they are doing it for a shorter period of time, at a general level, a permanent establishment is not created. However, in some cases, a shorter duration has been referred to in other tax treaty. I'm not talking about UAE specifically, where the nature of business is such that it requires a period of less than 6 months. The non-resident may be carrying out their entire business operations from such a place, or they may be carrying out part of their operations from such a place. But the place from which the PE is sought to be created should be one which is used by the non-resident on a regular or recurrent basis. The next condition is around the place should be at the disposal of the non-resident. Now, disposal simply means that, a non-resident has a right or access to that fixed place. It doesn't matter whether he owns that place or not, whether it is a rented one or not, whether it's a legal right or he's illegally using that place. So long as he has the right to use that place in his own account, the place is said to be at the disposal of the non-resident. The determination of PE has to be done on an annual basis. So it is possible that you may have a PE in year 1, but you may not have a permanent establishment in year 2. It is a fact-specific exercise which is there. And the core income generating activities of the non-resident should be carried out from such a place. Like I mentioned, in paragraph 3, there's a clear mention that if you are doing preparatory or auxiliary activities, those will not constitute a PE, even if they are done through a fixed place of business in the UAE. These are some of the examples as to what can be a permanent fixed place of business. It could be an office, a workshop, a factory, a work location, a machinery, or an equipment. Some of the factors which are irrelevant in deciding whether a PE exists or not is whether the place is owned by the non-resident from where the business is conducted. That would amount to a fixed place PE. There may not be a legal right as long as there's an effective control. Even if a place is occupied illegally, that can still constitute a permanent establishment. And there is no requirement that it should be an exclusive right of non-resident. So let's say think of a situation where there is a co-working space where the employees of non-resident are working on a flexi seat basis. So long as they have a right to get into the co-working space, sit down, work, do their work, even if they don't have an exclusive right to use a particular area of that co-working space, that will constitute a permanent establishment. These are some of the examples for an agency permanent establishment. So let's say, for example, if a non-resident has an agent in the UAE, right, who's acting as an exclusive distributor for the foreign pharma company, right? He meets the customers, he negotiates the contract, he prepares the contract, runs it past with the customer. The only thing that happens is the signing is concluded outside the UAE. In such a case, there can be a PE of this non-resident in the UAE. The second most common form of permanent establishment, which has been in a lot of debate and discussion over the past few years, is commissioner arrangements. Now, in a commissioner arrangement, basically what happens is that, let's say there's a non-resident and he has an agent in the UAE. This non-resident may actually supply goods to a customer. And the way the entire transaction is designed is as if this agent is getting the ownership of these goods in his name and then selling them, right? So on the face of it, it appears as if this is a transaction on a principal to principal basis, whereas in effect, the transaction is that the non-resident is actually just paying commission to the agent. In those cases also, a permanent establishment can arise. However, the situation will be different where a representative of a foreign pharmaceutical company is just going to doctors and providing them information around the medicines that the doctors may choose to prescribe to their customers, or rather the patients who are there. In that case, because there is no proximity of contract between the doctors and the foreign company, a PE may not arise. One other simple question that we keep on receiving very often is, just because a foreign company has a subsidiary in the UAE, does that mean that they also have a PE in the UAE? And the answer to that is no. Unless and until the activities of this subsidiary fall either under the fixed place of business test or under the agency PE, just because a foreign company owns this company, it would not result into a permanent establishment for the foreign company in the UAE. Now, while the nexus rule initially referred to the existence of an immovable property in the UAE, in the guide to the non-resident taxation, there are certain examples that have been given. The example relating to the rental from the leasehold land is something that we covered initially. But what about a non-resident having bank having certain ATM machines in the UAE from which the customers can withdraw money as and when they want? So in the UAE corporate tax guide, it has been provided that these ATM machines will also constitute a nexus of the non-resident in the UAE. The another example that is given in the business guide is if a wind turbine is something which is located in a seabed within the UAE territorial waters, the work generated by this turbine is something which is supplied to UAE customers, then even this wind turbine can cause excess and therefore taxability for the non-resident in the UAE. This slide basically covers the compliance part in relation to the non-resident. So just like the resident, once a non-resident has a permanent establishment or nexus and has a taxability, they are required to prepare the tax return on the basis of adequate and standalone financial statements, which are prepared in accordance with accounting standards which are accepted in the UAE, which is IFRS. These are generally required to be prepared on an annual basis, but under certain exceptional rules, they are permitted to use it on a cash basis as well. The income which is attributed to the permanent establishment or the nexus has to be calculated on an arm's length basis by treating the permanent establishment and the head office as a separate entity. Now, this is something again which is a very, very common problem in international taxation, which is that what happens if a non-resident, so let's say if there is a non-resident and then they have a branch in the UAE, by manipulating or playing around with the prices at which the transactions are done with the branch, the non-resident can actually impact the UAE corporate tax by changing the taxable profit. So let's say in case this branch makes purchases, if it does it at a higher value, then the expenses are higher and therefore the taxable profit is lower. Whereas if this branch were to sell goods to the non-resident, if they sell it at a lower price, again, the taxable profit in the UAE stands decreased. Therefore, it is provided that all transactions between the non-resident and the PE would be required to be done on an arm's length basis. In other words, the provision relating to transfer pricing will kick in and one will need to justify that the transaction price is based on the arm's length. The tax return by the non-resident is just required to be filed like a resident. They have to file the return and pay the corporate tax within 9 months from the end of the relevant tax period. So let's say if the tax period is 31st of December, September 30th is when this needs to be completed. And documents for a period of 7 years, during the end of the tax period to. And the last question is small business relief available to a non-resident person? So under the UAE corporate tax law, there is an exemption which is given for the initial few years, whereby if your revenue is less than 3 million dirham and you meet certain conditions, you may still not be liable to pay UAE corporate tax. But this relief is not available to a non-resident. In their case, let's say if it's a company, it doesn't matter what their revenue is, they're taxable as long as their income exceeds AED 375,000. If it's a natural person, if it's above 1 million dirhams, then they need to register, do the filing. Small business relief will not be available to them. So I think with that, we come to an end of the presentation for today.